Hi everyone, it's Simon here, Sunday the 29th of July with another market update for you. Well, last week the S&P 500 inched ever closer to a new all-time high. This level here, the 78.6 retracement level that I've talked about a few times, it has been convincingly broken above. So we've cleared this area, which has proven to be a pretty tough resistance level a couple of occasions. And this means that the previous all-time high in January is our new target, and I fully expect that that high will be hit and the S&P 500 will make new highs. I don't want to bet on a time frame for that because we are entering August, which is historically a pretty quiet and seasonally a pretty weak month for the US equity market. A lot of people go on holiday then. It's the Northern Hemisphere summer, and look, new highs may not be reached in the next few weeks, but certainly in the next few months, I think that is on the cards. Now, strength in the market recently is largely being driven by earnings. We're in the middle of a pretty good earnings season at the moment. The earnings beat rate is currently running at 84%. What that means is 84% of the companies in the S&P 500 are beating analyst expectations. Now, 84% is a very good beat rate. Historically, the beat rate runs at about 67%. So strong earnings helping to fuel the stock market. We also had a very strong GDP figure, 4.1% the economy grew at in second quarter. So that's the strongest rate of growth since 2014, and that should help buoy optimism towards the market as well. Now, unfortunately, it is difficult to talk about last week's market action and earnings without mentioning the Facebook story. Okay, Facebook earnings disappointed the market, and Facebook had an almighty gap lower on Thursday. Stock gapped open about 18% lower, losing approximately $120 billion in market cap. To put that in some perspective, that's equivalent to about $15 for every single person in the world. Okay, so it was a big fall, and there is absolutely nothing on this chart that would make me want to try and be a dip buyer here. And in fact, dip buyers got it handed to them on Friday with a close almost on the lows. And Facebook, I mean, it's a fantastic company. No other company in history has been able to monetize a business plan as quickly and as efficiently as Facebook. They're amazingly capital efficient, but they now service approximately a third of humanity. So that the law of large numbers is catching up with them. And as their growth rate slows, and as they sort of become ever more saturated in their market, the multiple that the market applies to that stock has to come down. So not one that I would be jumping into on Monday either. What is impressive though is that despite the historic fall in Facebook, the market kind of held its stuff together pretty well. We were down on Friday, but we're not seeing the market metaphorically wet its pants here. Okay, investors are not running to the hills. If we're in an environment where cash levels were really low or sentiment was really skittish, what happened in Facebook could have easily turned into a disaster, and that just does not appear to have happened. Let's have a look at the Nasdaq. Okay, the Nasdaq on Wednesday made a new all-time high. So what I'm going to do is drag this higher, and look, yes, the Nasdaq has fallen, but all we've really done is come back to our 21-day exponential moving average. Still a very strong uptrend here. Nothing to get too alarmed about. Yeah, we could certainly fall for another couple of days, but there's really nothing in this chart that gets me worried about further falls or a break of the uptrend. Going through the rest of the sectors, more of the same in basic materials. We still need to see it clear this 50% retracement level to get more bullish there. Financials, similar sort of story. Not able to close above this 50% retracement level, which as you can see has acted as resistance in the past. We really need to see it clear this level before we get more bullish on financials. Industrials, looking slightly better. We've cleared the 50% level, but it's the 61.8% level that has really been the tough nut for industrials to crack. We really, again, want to see it clear this level and convincingly close above it before we start getting more bullish on industrials. Tech sector, not surprisingly, continues to look pretty similar to the Nasdaq. Tech sector made new all-time highs on Wednesday and really suffered from the Facebook effect on Thursday and in particular on Friday. But again, trend here looks very strong. To me, this just looks like a pullback. So tech looks bullish. Consumer staples, talked about this last time as well. It's run smack into its 200-day moving average. It's smacked into this area that's 2 standard deviations above the mean level from this downtrend, and it's also at its 50% retracement level. So consumer staples got a lot of work to do here if they're going to clear this level. I would be more inclined to place short trades here using put options. You want to be very risk managed, because if these levels do get cleared, it could really turn into a bull market. But I think the odds favour a failure here and a decline. Real estate, on the other hand, uptrend here looks solid. Okay, this is a nice uptrend. We've had a bit of a pullback, but nothing to get too worried about here. Real estate looks good. Utility sector has cleared the 50% level. We really need to see it clear the 61.8% level to get more excited. But yeah, utilities look neutral to slightly bullish here. Okay, healthcare is looking better. Healthcare has cleared the 61.8% level. Surprise, surprise, it's run smack into the 78.6% level. You just can't make this stuff up. I mean, it literally touched that level and reversed. But you're more likely to give the healthcare sector now the benefit of the doubt for further upside. That's looking more bullish. And consumer discretionary really kissing at new all-time highs here. Opened at new all-time highs on Friday, dragged down by the broader market, but consumer discretionary looking like one of the more bullish sectors in the market. Energy sector is still looking pretty bullish. It's maintaining above the 38.2% retracement level from the April low. So I would give further upside here the benefit of the doubt as well. If we have a look at the oil price, you can see that oil has declined to the lower end of this trend channel, but this uptrend is still very much intact. So from here, I'm inclined to give higher oil prices the benefit of the doubt as well. If we have a quick look at the transports have also cleared the 61.8% retracement level from the January high to the February low. So starting to look more bullish. Again, the 78.6% retracement level, which is the previous resistance level, is the next target and the area we need to clear before we see new highs. But again, I'm inclined to give more upside the benefit of the doubt there as well. Bonds have been weakening. Gold price still looks pretty friendless. If we look at a weekly chart of gold, you can see that we're heading back to this 1200 area is probably a likely area of support, where it's kind of bottomed out on 2 previous occasions. I'm not getting too excited about gold at the moment, but if we do see it back around $1,200, look, you could argue that maybe there's a bit of time to do a bit of bottom picking there. S&P 500 futures look very much like the ETF. Again, new all-time highs is the next target. Russell 2000 small cap stocks within cooey of new all-time highs, weaker on Friday, but again, we've just pulled back to the 55-day exponential moving average here. Uptrend still looks pretty intact. And if we look at the advanced decline line, that also made new highs last week, showing that there is some real breadth to this uptrend. So all in all, folks, Facebook hasn't derailed the bull market. Earnings look strong, the economy looks strong, and really market technicals look pretty strong as well. I'm still sticking with this bull market. I think the path of least resistance remains higher. I hope it helps, and good trading.